smoothing basically has to do with a situation where you know that, like this one, you want to even bridge the particular concept. That you know you make a sales today, and that particular sales or income that you got today, assume you have a grant. This grant that you have gotten today, you are going to do something before you qualify for it. So until that one is done for you to qualify for it, you have no right to use that particular grant. Okay. So my boss, the money measurement concept is there. Yes, that what that one also says basically is in accounting, everything should be recorded in monetary terms with reasonable certainty. So what it means is that if there's anything that we cannot quantify in monetary terms, you cannot bring it. Assuming you are preparing an account and you have got a rumor that your staff is going to maybe embark on a strike action, you cannot say that I think that this one will cost me this, so let me budget for it and maybe put something there, because you cannot actually quantify the cost of that. So I put something there, skills and competencies of employees. You cannot qualify it, even though they are valuable asset to the company, but you cannot qualify that one. Maybe there's a lawsuit, as I said. You cannot say this lawsuit, even though I know I'm at guilt, so I'm going to maybe use this one to defray the cost, so let me put something there. You cannot determine that one with reasonable certainty. And let's say there's internally generated goodwill. If, let's say, this place was put up some time ago, and another building is elsewhere, or maybe around this place is sold at a goodwill, you cannot sit here and say, I'm also putting a value on my company and add a goodwill, because you can also not determine that one with reasonable certainty. Am I? Is that okay? Then we look at prudence. Can someone also help me with prudence? Yes, sir.
Okay. This principle seeks to entreat accountants or business people to overestimate expenses and underestimate income, so that in the event that the expenses are less and the incomes are more, you stand to benefit, or it won't throw your budget out of gear.
Okay. Yes, can someone also help? Yes, as he said, basically with the prudence concept, as like English words, you have to be prudent. You have to be more conservatism, that you don't understate your, let's say, expenses and overstate your income. So what it means is that when you are preparing an account and you think that you are going to incur a certain expenditure, it's better to even state it higher than to state it low, so that at latter days, if it actually hits you, then you can have a way to hide. But if you also know that you are going to get this income, assuming you are going to get income of, let's say, 10,000, and you are not all that sure, it's okay, maybe I'll get 12,000. Then you take 12,000. The prudence will tell you that it's better as for income, you take the lowest, so that in future, when you get this more, then you have a better performance than what you actually predicted. The essence of this basically is that if you're an accountant of a place, and you go and tell your manager, I expect that at the end of this month, you are going to get $10,000 profit. And the manager will say, oh, that's a very good accountant, thank you. You go there because by that time, you have already understated your expenses and overstated your income. Then it turns opposite, that now the incomes go low and the expenses go high. Definitely the profit is going to maybe can even turn into loss. Then you go and tell the same manager, oh, manager, what I told was not right. We actually had a loss. What will he say or will he do? He might even think that, oh, after seeing that you're making profit, you're being shifted it elsewhere. So it's better to go and tell him that, manager, I expect that you're going to get 5,000. But later, when you go and tell him that you had 10,000, the manager will say, we are a very good servant. So that's what that particular principle is trying to maybe guide us. Then we look at realization concept. Can someone also help me with realization concept? Yes, sir. Are you getting the concepts? Yeah. Because we might be using them in our subsequent slides.
This one seeks to suggest to accountants or business people when to recognize income as earned or expenses as incurred. So for income, those accountants or business people can recognize it as earned when the service or that particular good is in the custody of the buyer, whether cash or money is received or not. So long as that particular good or service is in the custody of the buyer, you should recognize that particular revenue as earned. Then with expenses too, it will be the vice versa.
Okay.
So long as that particular service has been rendered to you, whether you paid or not, you should recognize that particular expense as incurred.
That is perfect. Thank you very much. Thank you very much. Yes.
He said it all.
Yes, he said it all. He said it all. But the only thing I'll add is normally when you dispatch the goods to the person should first accept liability that indeed are accepted. But then you have transferred all the risk and reward of that particular asset to the person. Assuming you have a car, you want to sell the car, and somebody calls you on phone that I need the car, and you send it to a person. Maybe parking the car in the presence of the person doesn't mean that the person accepted it. He should accept that, yes, indeed, I've accepted and I'll pay you. So thank you very much for this. Yeah. We look at consistency concept. Can someone also help me with consistency concept? Yes, sir. Okay, question. Yes, sir. Okay.
Sample and how do you consider it? How should I report it? Because how you to the destination? It's in transit.
Yes.
How do I report it?
Yes, at that time it's still your goods because it's in transit. The person has not received. That's why I said the person should accept responsibility of the delivery. Because if, assuming that the person sends somebody to come for it from your premise, that one you will hand it over there. So once it's on the way, it's not your issue anymore. But if you have to deliver the goods to the person in his premises, then it should get to the person for the person to accept before you can see your mistakes. Is it okay? Thank you very much. Yes, sir, boss.
And that is where insurance also comes in because you need to insure the goods in
yes, in transit.
Once it gets to the destination and the person accepts responsibility, then you are at peace.
Yes, please. Thank you very much for yes.
We have some businesses that are more of like distribution business.
Okay.
Where you take the stock, you sell, whatever you are able to sell, you pay for it. If you are not able to sell, you can take it back. What happens in that situation?
Can you come again?
You know, maybe my business is distributing something, a product for a company.
Okay.
Now I take stock and distribute them.
Okay.
If it happens that I'm not able to sell or those particular ones, I can send them back to the business, back to the company.
Yes, so once that particular arrangement is there, it means you don't have a responsibility. You see, we look at whether the risk, because assuming that goods is in your care and there's fire, who bears that? You see, who bears that? Once you have the right to send it back to the person, you cannot say that particular goods you have purchased them. It's not a cost to you, so until it's being sold. Is it okay? Because that particular person will still keep it as part of his stock. So until you go and pay for it, it's still stock in the book of that particular person.
I wanted to find out, is there a relationship between the realization concept and the accrual and matching?
Yes.
And then, please, come again on the accrual and the matching concept. It didn't come clear to me.
It didn't come clear to you. Okay, with the accrual and the matching concept, what we are saying is that right now, assuming you are staying in this particular building, you have rented this place, you have not paid for it. When you are paying your accounts, you can't say because I have not paid for it, I'm not going to take it as an expense. You know definitely that you pay for it. So the matching or the accrual concept will tell you that this particular place that you have used, you have to take charge of it. Let's take electricity for instance. It's only recently that we do this prepaid. Before it was postpaid. So you use before you pay. So if now, at the end of the month, your bill has not come, you can't say once the bill has not come and I'm paying my accounts, I'm not going to maybe take charge of it. Because you consume it in that particular period. So every expenses or income that happened in a period should be reported in that same period. Whether you pay for it, receive, or you have to account for it in that same period. Yes, sir.
The example you just gave, you don't even know the amount yet.
Sorry?
In the example you just gave, about the bill.
Yes.
You've not received the bill yet, so you don't know the amount yet.
You don't.
You don't know the amount.
But that's what I say. In accounting, we do provisions. So that you can just suggest that, okay, if I look at the trend, this is what I've been paying. Is it okay? Yes, sir.
Yeah. With the issue about the realization, what about if you deal in goods where you give like warranty to people? How do you treat that? Maybe you expect that maybe the person has accepted responsibility for the goods, but there's a warranty on it, and then maybe 2 years, and then all of a sudden the person tells you, well, within the period there's a problem with one of the products.
So at the time that you sell it, you will still take it as sales, but you have to make a provision. You see, you have to make a provision that it's possible these goods that are sold within this month or this period, a portion of them will come back. So you make a provision and set something aside. So if they come, then that one can set off against that. But still, you have to take it as sales. Thank you very much.
Yes, sir. If the person, like, you sell something to somebody, but you pay later, about like a year later or 2 years later, can you record it as a sale and put it under the debtor?
Yes, that's why, as we go, you see that when we make sales, we have cash sales and credit sales. So when the person pays cash, that one, hallelujah. That's why my sister asked a question about the difference between cash and profit. You can have profit, but you don't have cash, and that is going to frustrate your cash flow or your liquidity. So yes. Yes, boss.
I want to dwell on the question asked by the man who supplies the goods, not selling all, and has to return some to the producer.
Yes, sir.
Is there going to be an oral contractual agreement or written document to support that arrangement? So that should there be a case of this fire disaster and the supplier resort to the use of courts to dispense of the problem, how would this very individual exonerate himself from that problem?
What you have to do in such instances, there should be a contract. And definitely the thing says, if you don't sell, return it to me. So if you don't return, it means you have sold it. You have to pay for it. Yes, sir. No, let me finish. Boss, yes. So the contract should specify, but definitely I know if I were the one who is giving the goods to you to sell, or if you don't sell, return it. But I only accept return. If you return it, then I'll give your money back to you, or I consider it as not sale. But if you don't return it, definitely you have sold it. Yes.
Right. Yes, I want to find out about the decentralization concept. I know if you look at most of the shops, or let's say like they will say goods sold are not returnable. Goods sold are not returnable.
Yes.
But like you buy that property home, you need to realize that they fit do that. How do you do?
Yes, that's why the person too, when you are going to buy anything, that is a contract. The person gives the invoice. Normally you go for the pro forma invoice. Instead of talking about pro forma invoice, you look at it and see the conditions. So when you are going to buy things, it's Ghana that sometimes when you are going to buy things, you just go and take them, only to go home and read the manual that they give to us. You have to read it and see what is on it. When it is there that goods sold are not returnable, then you have to make sure that that particular goods, if it has to be tested, let it be tested for you that it is of good quality. So in that instance, that's what you need to do. Yeah. Okay, we are looking at consistency concept. That one is also saying that this particular accounting that we are trying to maybe, okay, this accounts that we are trying to prepare is for the consumption of other people. You know, we have so many stakeholders in whatever that we prepare. So for you to compare like Ghana, for instance, let's compare this year to last year. For you to compare, you have to put them on the same basis before you can compare. When you have two, maybe children, and they go to school, one is in Form 2, one is maybe Form 1. You cannot compare their performance because they are not at par. So what this concept is saying is that if you use one concept this year, try and also use the same concept next year. But you can change it. If you change it, try to disclose it for people to know that the last year one was based on this principle, but this year is also based on another principle. So that people will just understand. Substance over form. Yes, what example is that? Yeah, for instance, example is simple. Assuming you have a car, that we have different forms of depreciation. You decided to choose, let's say, reducing balance, and you've been using reducing balance for a very long time. Now you decide to use straight line. Definitely, someone will not get understand unless you disclose that this one is now changed to this particular. Sorry? No, interest or no is different. It's different. If someone is no, so it depends upon the reporter. If you are the one paying for it, so if you are the one paying for it, that one you cannot disclose. Yes. Yes. We look at substance over form. Substance over form. That one is basically. Hello.
Hi.
Are you with me?
Yes.
Yes. We are looking at substance over form. Sometimes there can be a transaction where you look at the legal structure of that particular transaction and also look at the economic sense of that particular transaction. This says that let's look at the economic substance of the transaction and follow that one instead of the legal one. Example, I can sell my car to you on hire purchase. And the law, we can maybe find out and say, that, okay, this law purchase agreement is that when I'm giving for, let's say, no, on a lease, let's say a lease. That will give you more understanding. I give it to you on a lease. And in lease, we have finance lease and operating lease. Okay. So, assuming I give it to you on operating lease, if we find out that the amount they are going to pay to me is more than about 90% of the value, in effect, we can see that indeed it's a finance lease. So we look at the actual sense of it, because assuming an asset has, let's say, 5-year span, and you are going to use it for about 4.5 years. At the last half year, nobody will actually maybe purchase it. So we look at the economic substance of it. Done. Let's look at the going concern. That one, when you are paying accounts, we assume that this particular business that you are forming will be there today, tomorrow, and forever. So you don't assume that the company is just going to collapse tomorrow. We look at a single economic entity. That one basically has to do with where we have a group of companies. That you have a parent company and subsidiaries. When you are paying accounts, you have to prepare it as one economic entity. One economic entity. You don't prepare them as separate entity. That's why if you pay some of the banks or some of the companies, you see that there's a consolidated financial statement. You see only for the company parent and that of the group. So the group is what we are talking about, a single economic entity. Yes, we are looking at element of accounting system. We want to know how you can have effective or proper accounting system. So I hope this is where we are now going to start, and some of the principles that we just outlined are going to be applied here. So the first one has to do with the financial year or the period. Every company, sometimes some people think that every company starts from 1st January to 31st December. It's not so. So you as a company, for you to have a proper reporting, maybe period, you have to determine that I will prepare my accounts from this period to this period. So you have to determine your financial year, not necessarily from 1st January to 31st December. Then you also look at the assumptions that you're also going to base on to prepare your accounts. The going concern, how you said. When you are preparing the accounts, everybody picks it and the person should understand that this one has the vision that the company will be there today, tomorrow, and forever. So if you think that the company is not going to be there forever, then you call something break-up basis. You have to prepare the accounts as if you are going to break up in the near future. We look at the accrual, as I said. When you are paying your accounts, for you to show a proper accounting, don't say these are the only cash that I received and these are the only cash that I paid out. If you use that one, in a period that you don't receive any cash and don't also pay any cash, it means you did zero performance. So the concept is saying, even though, and there's no way a company can in a month not other maybe receive or maybe pay, or maybe incur expense or receive income. So at that particular instance, the concept is saying, try and take charge of all those things. We look at the historical cost. That one, when you get to assets, we understand that when you buy an asset, as you buy a car, and you go to the market, let's say you bought it this time at 10,000. You go to the market, and now the market is 15,000. You should have a policy that I always match my car to the market. Or you can have a policy that when I purchase it at cost, it's always at cost. I wouldn't be looking at what's happening on the market. So that one, it means you'll be following the historical cost concept. Then when you also want to match to what is going on the market, then you will be using constant purchasing power or current cost accounting in the market.
Back to accruals. Supposing I have some utilities or some bills for 2014 that I couldn't take care of, and I actually made payments in 2015. How do I capture that?
Yes. So in that instance, you said you didn't take charge of it. Did you forget or you didn't pay? If you didn't have the capacity, the law says take charge of it and take an expense in 2013. By 2014 is where the actual cash flow outflow will take place. Do you get it? But if assuming you forgot to take charge of it in 2013, and it's now that you've seen that, oh, I had this, that I forgot, it means the account that you prepared there was not complete. But we look at whether it's a material error. If it's a material error that can affect the position that you posted last year, then you have to restate last year's position. But if you didn't, that's what I say with the accrual say whether you have capacity or you don't have, just prepare for it. Just provide for it as an expense. Because when you have provided that one as an expense, it doesn't actually go with fiscal cash. You are compiling your income here, your expense here. Accrual is saying you have consumed this to generate your income for this period. Otherwise, if you're an accountant, all these concepts, because of our time, but let me try to explain something, maybe the thinking of these concepts. If I'm an accountant and I want to resign next month, I decide to maybe shift all my expenses to next month, and then I'll post more profit, and everybody will be clapping for me. Then when I go, then the next accountant will come and pay all my expenses. So the law will force you to make sure that you pick every expenses that you incur in your time. I'm trying to also give you at what point do we recognize an asset or element of this accounting that I talked about. You know, I talked about asset, liability, income or revenue, and expense. So at what point do we recognize them? This was an item shall be recognized or should be recognized in accounting system if it meets one of the definitions above. You know, I gave the definition of asset. I gave the definition of liability. I gave the definition of equity. I gave the definition of income and that of expense. So if it meets one of them, then you can recognize. And the last point there, and can be measured at a monetary amount or cost with sufficient certainty. So even though it meets the definition, but the figure that you attach that particular asset or liability or revenue or expense should be something that you have sufficient certainty that is what will happen. When you look at in our businesses, I hope we have more entrepreneurs, different business around. We look at how we acknowledge receipt or proceeds. Proceed is like when you sell. So we have to know objective of acknowledging our receipts in our system. And one objective is to ensure proper accounting for all receipts. If you don't take charge of your receipts, all your monies will be falling to some pockets. So as an entrepreneur, you have to make sure that you have a proper way of receiving all the sales that you make. And also to ensure transparency in your finance or cash management. Then receipts should include basically two. Either somebody gives you cash or give you check. So whether you receive cash or check, you have to give a receipt to you. And all receipts that you receive, whether cash or check, should be acknowledged with official receipts from your end. That official receipt you have received, which is well kept, so that nobody can easily just get access to it and use it for any other business. Then it should be properly recorded. Then bank appropriately on daily basis. Sometimes when you make sales on daily basis and you put the sales down or the money down, it's there that some people can have advantage. So as entrepreneurs, to have a very good custody of your cash system, it's better that every day you try to bank it. But assuming it is highly impractical for you to bank on the same day. Then the following day, so I say where it's highly impractical to bank any receipt or proceed on a particular day, such as not making banking hours. Assuming you went there, you didn't meet banking hours, then special approval should be granted for its upkeep in a locked safe. At least a manager over there should be able to show that yes, this person could not maybe bank this money because of this, and I authorize him to keep in a locked safe. Then should be in a special custody of the accountant or bank in early hours of the next banking day. Then a different personnel, other than the one who acknowledged receipt, should bank all receipts. Return all bank stamps in slip to the acknowledger. So, assuming in a proper system, it's better that whoever takes the receipts, either cash or check, the other person also should also bank it. That one shows segregation of duties and also bring more controls. But if you allow one person to take cash and also bank it, something after all can happen. The person can easily manipulate the figures and bank what he or she wants to bank for you. So it's better you have two different people to handle this important assignment. We look at annual budget. Let's all try to understand why the need for annual budget. You cannot sit in your office and expect to make profit. This one, even though we are trying to suspend questions. Is there any company here who expect to make profit at the end of this year? Yes, you expect to make profit of how much? 10,000. How about loss? You expect to be. Yes, you should be able to determine that is on annual basis. I'm going to end the year either with a profit or a loss, so that you can know the strategy you have to put in place to survive in that particular year. If you don't do this, loss is not something bad. It depends upon your situation. Assuming you are a new business and you are trying to expand, definitely most of the capital that you have will be invested in the expansion that you are doing. So if you run at a loss, it's not anything bad. Definitely in future, they will pay for it. The reason why there's the need for you to do budget is to sustain and hold a vision statement. Every company, I know you've taken two business for a lot of things, so I hope by now most of us are clear with vision statement. So for you to be able to achieve the vision for which that you set your company, or your company exists, you have to do a budget so that it will be in line with it. But if you are just there and you allow everything to happen the way that it wants to happen, then there's no way it can easily align with the vision that you set for yourself. Then if you have the board, I will urge that no matter how small it is, try and have a board in place. The board will help you with your corporate governance. It might maybe give you additional costs, all right, but it can also improve efficiency in operations. So it's better if you have board in place, you try to give that particular budget for the board to approve. Then the budget will also propel and motivate employees to give out their best. If you don't set budget and you tell your people that this year we expect to make a profit of 10,000, as my brother said, there's no way anybody will be energized to maybe help you to achieve the profit. Because you sit in office and you have your vision or your profit in your head. But if you set budget and let people know that is what we want to achieve at the end of the year, and if you are going to get a bonus or any salary increment, it's going to be based upon how we are able to perform. Everybody will buy into it and try to help you to achieve the budget. Then also to form the basis to measure and monitor actual performances. So whether you are doing well or you are not doing well, you cannot tell. But it's only when you set what you want to be in future that you can compare and see whether indeed you are doing well or you are not doing well. Then annual budget estimates shall be prepared, should be prepared and justified by the board before. It's better that as a company, this year, now we are in September, some of the business have started preparing their budget. So it's better you know, or maybe you approve or get a budget approved before December or by December. So by the time you start on the 2nd of January, I know 1st January is holiday, 2nd of January, you already know how much you are going to maybe start. So when you are going to maybe 31st all night, then all those things will be in your prayers. And just pray that I want to achieve this, so that you're able to get there. Then the expected performance and positions of the 5 elements that I talked about, you should be able to determine how you want your capital to grow to the end of the year, the expenses that you want to maybe have in the whole year, the income that you expect to maybe generate in the whole year, every element that you want to achieve. And that one will determine the size of your balance sheet and also determine the profitability you're also going to make for the year. In some cases, not all budgets are achievable. You can do budget, if you do budget, let's say last year, December, that you are using it this year. And at this time, you can see that this budget is far off my target. It's better you have to revise it. So you have to revise your budget, especially when you are having adverse variance. That you expect to make profit, then everything is turning differently. Then it's better you do a revised budget and send it to whoever approved the budget for them to give you other estimates. Then how do you ensure that this budget that you set for yourself, actually you are implementing it, or it's likely that you're able to achieve it to the end of the year? You have to try and break down into monthly basis. Every month, you should be able to determine that this profit that I expect to make at the end of the year, how much I'm going to make every month. Some people will say, let's make it even, or maybe straight line, that if I'm expected to make 12,000 at the end of the year, then I should be making 1,000 every month, so that by the end of the year, I'll get there. Somebody can also say, oh, looking at 1st January, or maybe January as the first month of every year, activities are so low, so I cannot achieve much. So depending upon the assumptions that you use for your budget, then you should be able to break them into monthly. Then that month, once you set monthly budget, you can actually compare to see if I'm not actually even to make the month, then how can I even achieve the year? Because the same month that you are adding together to get the what we want to achieve at the end of the year. So it's better you break all the budgets that you have for the year into monthly. Then one important thing that sometimes we fail to do is we don't do review on monthly basis. Some companies think that one should be a cost, but actually it adds value. When you do, try to meet the important stakeholders in your company, especially internal staff, and review your performance. That is the performance that we set for ourselves for the year, because you will let them be aware that is what we are expected to achieve for the month. So if you are not able to make it, then all of you have to be able to review, then give reasons for your variances. So you can put the right measures in place to make sure that the budget is achieved. Then, the budget, as I said, your budget for statement of financial position, that's the balance sheet, your income statements, cash flow statements, and the variance analysis. So every month, you should be able to have all these things. So the variance analysis will tell you why you are not achieving the target that you set for yourself on monthly basis. And definitely, if you are not achieving it on monthly basis, there's an indication that you are going to deviate from the budget. But it's better you get a hint at the earlier stages and put the right measures in place to avert a particular non-performance or not achievement of the budget before the year actually comes to a close. Okay. We look at fixed asset management. Most often, some of the businesses collapse because of the way we manage our fixed assets. Because you can have a company where when they buy assets, they don't even know whether I should classify this one as a fixed asset or capital revenue or capital expenditure or revenue expenditure. So the fixed asset that you have, as I said, I'm throwing this one through the budget. You have already budgeted the asset that you want to purchase in the year. That one will form part in your annual budget. So all the purchases that you are making, make sure that they go in line with the budget. So to control acquisition of tangible fixed assets in line with the approved annual budget, the asset needs of the firm. You can budget it, but maybe at some point in time you are not needing a particular asset, because maybe you thought that I will do this and maybe need particular asset to do it, but that particular business that you need asset for is not actually forthcoming. So there's no need for you to get that particular asset there while you don't have any use for it. So it should be in line for the asset needs of the firm that you are running. Then to ensure that our fixed assets are properly recorded and identified completely. To ensure that fixed assets are properly accounted for, secured and put into their intended economic use. So if you buy assets and today you don't have any use for the asset, definitely you are going to put it down, and that one is definitely a cost. It's going to drain your cash flow. So it's better you make sure that whilst it's in line with the budget, you also have a business needs for that particular asset at the time that you purchase the asset. Then you also see to control the maintenance, disposal, and continuance of all fixed assets. We have some companies that maybe some of us here want to ask, what is the value of your fixed asset that you have? There will be a problem here. Some of us might not tell maybe at a glance how much value of asset that we have. But there's something that we should have and know that all the assets that I have, everything is recorded. They ensure fair depreciation of fixed assets and accounting for any impairment adequately. Let me talk about depreciation and impairment briefly. For depreciation, when you buy asset, basically that asset will have a depreciable value. And that asset is on monthly basis, on daily basis, contributing to the income you are generating. So you cannot say once it was a one-off payment that I used to pay this particular asset, I'm not going to cater for it. The years that I'm going to use the asset should pay for that particular asset, so that in case you eventually sell it or there's no economic value for that particular asset, you can have a replacement of that particular asset. Then impairment, you can have the asset all right, you have your depreciation all right, that you are depreciating. But you can see that per the depreciation that are provided, assuming you purchase the asset for 10,000, you depreciate about 5,000. Now you are left 5,000. But when you go to the market, or something has actually happened to the asset, that you know this particular asset, there's no way I could drive or I can drive whatever amount I want to drive from it for the rest of its term. Then it means that difference becomes impaired. And per the regulation or per the international financial reporting standards, you have to do that particular off against your books. That's why you say the asset is impaired. Then the company should have policy on cost. As a company, who can give me any policy of cost policy of assets of his company, his or her company? The policy. At what level do you capitalize it? And at what level do you actually expense it? You should have a policy that any time I purchase anything which exceeds this amount, it should be capitalized and written off over a period of time. So that policy should be there. If you don't have that particular policy, then whoever is handling your books can decide subjectively that, oh, this one there, this month I'm not doing well, so let me take it next month, or this month I'm doing well, let me charge it. But just write your policy and tell the person that any time it exceeds this amount, it should be written off over a period of time. Then it should be well identified. If you have asset, it should be identified with the location, with the department, with the asset, everything embossed on it, so that whoever finds the asset will see where it belongs to. Then you also need to have a register for all the assets. Can someone tell me why we need a register for assets? Can someone help me with this, sir? Why we need a register for assets?
Insurance.
Okay. Insurance one. Movements, okay. And also, when you have assets, you know, with the register, it will put down the date that you purchased it, where you actually purchased it, and with the date that you purchased it, when you are even depreciating it, assume you have a straight line method of 25%. Definitely, if you purchase an asset this year, 4 years time, it should be what? Fully depreciated, and you shouldn't charge it against. We have some companies who are actually overcharging their depreciation, and depreciation can never be zero or negative. It can be zero, cannot be negative. But if you have an asset and you are using a straight line method of, let's say, 25%, it means by 4 years time, the 100% cost of that asset is gone. So you have to stop depreciating it. But if you don't keep a register which will identify the asset, then you will just depreciate every year and you'll be reporting losses where that particular money is not going to anyone's pocket. Yes. But why are companies?
Some companies charge an already depreciated or expired asset as depreciation, as they keep charging every year. What's the true purpose?
Yeah, it might be that they don't have proper accounting system. But if you have a proper accounting system, definitely you know that a purchase particular asset, it is a policy. So by 4 years' time, it's fully depreciated, or maybe 5 years, it's fully depreciated, and you have to stop. It will just affect your profit, because charge against your profit. And as I said,